The United States recently ordered Chevron, the world's largest energy company, to completely withdraw from Venezuela's oil industry by April. At the same time, the U.S. announced a 25% tariff on any country that buys Venezuelan oil or natural gas. On the surface, this appears to be another round of sanctions against Venezuela's struggling economy. However, the real target seems to be China, Venezuela's biggest oil customer and strategic partner. Despite these new U.S. restrictions, China has actually increased its imports of Venezuelan crude oil to 400,000 barrels per day in March 2025, the highest level since June 2023. This bold move raises important questions. Why is the U.S. suddenly tightening sanctions on Venezuelan oil after easing them under Biden? And why is China willing to risk U.S. penalties to maintain this energy relationship? Venezuela sits on the world's largest proven oil reserves, about 300 billion barrels or 18% of global supplies. However, years of U.S. sanctions have crippled its oil industry. Production plummeted from 1.9 million barrels per day in 2017 to just 350,000 barrels at its lowest point. The Biden administration had temporarily relaxed some sanctions, allowing U.S. companies like Chevron to resume limited operations. But the Trump administration's new policy represents a complete reversal, with the added threat of secondary sanctions against any country trading Venezuelan oil. China's response has been particularly defiant because Venezuela plays a crucial role in its energy security strategy. Over the past 2 decades, China has invested more than $55 billion in Venezuela's oil infrastructure through oil for loans deals. Today, China purchases about 68% of Venezuela's oil exports, approximately 500,000 barrels per day. These supplies help fuel China's massive manufacturing sector while providing Venezuela with much-needed revenue. The U.S. move appears designed to pressure China on multiple fronts. By cutting off Venezuela's oil exports, the U.S. aims to disrupt China's access to affordable energy while escalating the ongoing trade war. The 25% tariff on Venezuelan oil comes on top of existing 20% tariffs on Chinese goods, potentially pushing total tariffs on some products as high as 45 to 70%. This represents a significant escalation in economic tensions between the world's 2 largest economies. China's refusal to comply with the U.S. sanctions demonstrates its growing confidence in resisting American economic pressure. Beyond simply maintaining oil imports from Venezuela, China has retaliated with its own tariffs targeting key U.S. exports including agricultural products and energy equipment. Chinese refiners have also become more sophisticated at circumventing sanctions through methods like ship-to-ship transfers and obscured ownership structures. The global energy market is watching closely as this confrontation develops. While the U.S. seeks to isolate Venezuela and pressure China, the practical effects may backfire. Higher tariffs could ultimately raise costs for American consumers, with estimates suggesting U.S. fuel expenses could increase by $5.2 billion annually. Meanwhile, China continues diversifying its energy partnerships with Russia, Saudi Arabia, and other producers to ensure stable supplies regardless of U.S. sanctions. This emerging energy Cold War highlights the shifting balance of global economic power. As China demonstrates its ability to defy U.S. sanctions regimes, the effectiveness of American economic statecraft faces new challenges. The outcome of this confrontation could reshape global energy markets and determine whether unilateral sanctions remain a viable tool of foreign policy in an increasingly multipolar world. What do you think? Can the U.S. successfully pressure China through oil sanctions, or is this strategy doomed to fail? Let us know in the comments, and don't forget to subscribe for more analysis of global energy geopolitics.